If I asked you right now whether your will controls everything you own, many people would answer yes. That answer feels natural. It feels logical. If a person writes down where they want their assets to go after death, then those instructions should control the result. That is what most people believe. And that belief is one of the most dangerous misunderstandings in estate planning. A will does not control everything you own. It controls only a specific category of assets. And if you do not understand that category, you can create outcomes that are the exact opposite of what you intended. This is why estate planning must begin with structure, not emotion. People often think estate planning is about fairness. They think it is about family promises. They think it is about what a parent meant, what a spouse expected, or what children believe should happen. But the legal system does not distribute assets based on what feels fair. It follows documents, titles, contracts, beneficiary designations, and court processes. That is the first principle. Assets move according to legal structure, not personal intention. If the structure is right, your wishes have a chance of becoming reality. If the structure is wrong, your wishes can be ignored without anyone doing anything dishonest. That sounds harsh, but it is true. Nobody has to betray you for your estate plan to fail. The paperwork can do it all by itself. At its core, estate planning is about three questions. Who is in control? When does control change? How do assets legally move from one person to another? If you understand those, wills and trusts become much easier to understand. If you do not understand them, you may buy the wrong document, place the wrong confidence in the wrong tool, and leave your family with confusion during one of the hardest periods of life. The mistake many people make is that they treat a will like a master command over all assets. It is not. A will is important. Almost every adult should have one. If you have one, it becomes even more essential. But a will is not the universal remote control people imagine it to be. The legal system asks mechanical questions. How is this asset titled? Is there a beneficiary designation? Is there a contract? Is the asset owned by a trust? If none of those mechanisms apply, then the asset may fall into probate, and only then does the will take its role. This is the second principle. A will controls probate assets. It does not override assets that already have another legal transfer mechanism. Once you see this, estate planning stops being mysterious. Assets move at death in three main ways: by contract, by title, by probate. That is the basic map. The first way is by contract. Some assets pass automatically because you signed a contract or beneficiary form. Retirement accounts often work this way. Life insurance often works this way. Payable. On death accounts can work this way. Transfer. On death accounts can work this way. When you name a beneficiary, you are not just writing down a preference, you are creating a binding instruction with the institution that holds or administers that asset. At death, the contract executes. The asset moves to the beneficiary, the will is not consulted, the court does not need to interpret your feelings, the contract controls. That is why beneficiary forms are so powerful. If your will says one thing and your beneficiary form says another, the beneficiary form usually wins. This is where many families are shocked. A person writes a will saying everything goes to the children, but the life insurance policy still names a sibling, an ex-spouse, or someone else from many years ago. When that person dies, the money goes to the named beneficiary. The children can point to the will and say, but this is what our parent wanted. The answer is that the beneficiary designation controls, not the will. That is not a moral judgment, it is legal mechanics. This is why beneficiary designations must be reviewed regularly. Life changes, marriages happen, divorces happen. Children are born, relationships change, people die, accounts move, policies are forgotten. A beneficiary form completed 20 years ago can still control a large asset today. If the beneficiary form is wrong, your will may not fix it. That is the third principle. Old beneficiary forms can defeat new estate intentions. The second way assets move is by title. Title means ownership structure. If property is jointly owned with rights of survivorship, the surviving owner automatically becomes the full owner when one owner dies. This is common with married couples who own a home together. It can also happen with joint bank accounts and other jointly titled property. Again, the will does not control that asset. The title does. Imagine someone is in a second marriage. They own a home jointly with their current spouse. Their will says they want their share of the home to go to a child from a previous marriage. Many people would assume the will protects that child. It may not. If the home is titled jointly with rights of survivorship, the surviving spouse may become the full owner automatically at death. The child from the prior marriage receives nothing from that asset, even if the will says otherwise. This is not because the surviving spouse ignored the will. It is because the title structure already determined the result. Ownership structure can trump testamentary wishes. That is the fourth principle. How you own an asset can matter more than what your will says about it. This is especially important in blended families. Second, marriages can create estate planning traps because different people may have different assumptions. A spouse may believe the home belongs to them after death. Children from a prior marriage may believe a parent's share should go to them. The will may say one thing, the deed may say another. The legal outcome follows the structure. This is how conflict happens. Not always because people are greedy. Often because the structure was never aligned with the intention. The third way assets move is by probate. Probate is the court-supervised process of transferring assets after death. It applies to assets that do not pass by contract, by title, or through a trust. If an asset is in your name alone, has no beneficiary designation, has no survivorship structure, and is not owned by a trust, it may become a probate asset. This is the bucket A will controls. The will tells the probate court how to distribute those probate assets. So when people say, my will controls my estate, the more precise statement is this: my will controls the assets that fall into probate unless something else legally controls them first. That is a very different sentence, and it is the sentence families need to understand. This is the fifth principle. Estate planning begins by identifying which bucket each asset sits in. Contract, title, probate, trust. If you do not know the bucket, you do not know the plan. Now, let us slow down and define what a will actually is. A will is a revocable legal document. Revocable means you can change it while you are alive and competent. You can amend it, you can replace it, you can revoke it. It expresses your wishes for the distribution of probate assets after death. But a will has no legal effect while you are alive. It does not manage your money. It does not move assets. It does not help if you become incapacitated. It just sits there until death. Then it becomes operative through probate. That is why a will does not avoid probate. A will begins probate. When a person dies, the will is filed with the court. The court process begins. The executor or personal representative is appointed or confirmed. Assets are gathered. Debts and taxes may be paid. The remaining probate assets are distributed according to the will. The will operates inside the court system. It is not a way around the court system. This is the sixth principle. A will is not a probate avoidance tool. It is a probate instruction tool. This distinction matters because many people pay for a will believing they have avoided a court process. They have not. They have created instructions for the court process. That can be perfectly fine in many cases. Some estates are simple. Some states have relatively efficient probate procedures. Some families are harmonious. Some assets pass mostly through beneficiary designations anyway. In those cases, a will may be entirely sufficient. But if you are trying to avoid probate, a will alone does not accomplish that. Now, what can a will do? A will can name an executor. The executor is the person responsible for administering the probate estate. This person gathers assets, works with the court, pays final bills and taxes, and distributes what remains according to the will. In practical terms, the executor is the administrator of the estate. A will can also name guardians for minor children. This is one of the most important things a will can do. If you have minor children, the will is where you formally name who you would want to raise them if something happens to you. A trust cannot do this. A beneficiary designation cannot do this. A bank account cannot do this. A will is the legal place where you nominate guardians. A court ultimately has authority to appoint the guardian, but your will is where you make your wishes known. Courts generally give weight to those wishes, unless there is a serious reason not to. If you have minor children and no will, you are leaving one of the most important decisions in your family's life to a court process without clear written guidance from you. That is the seventh principle. If you have minor children, a will is not optional. Even if you have a trust, you still need a will for guardianship. This is why the conversation is often not will or trust for parents. It is will and trust. The trust may handle assets. The will may nominate guardians. The documents work together. A will can also direct probate assets to beneficiaries. It can say who receives what in what shares and under what terms if those assets fall into probate, but it cannot override beneficiary designations. It cannot override joint ownership with survivorship. It cannot avoid probate. It cannot manage assets during your incapacity. It generally does not reduce estate taxes. It generally does not protect assets from creditors, and it does not control everything. That is the eighth principle. Every estate planning document has boundaries. Danger begins when people assume a document does more than it actually does. Let us take a simple example. A person dies with a will that says everything goes to the children. They also have a life insurance policy naming a sibling as beneficiary. They own a house jointly with a spouse. What happens? The life insurance goes to the sibling because the beneficiary designation controls. The house passes to the surviving spouse because the title controls. The will controls only whatever probate assets remain. If the person's real wealth was in the life insurance and the house, the will may control very little. The children may say this is not what the parent intended. Maybe that is true, but the system follows the paperwork. That is why estate planning is not only about drafting one document. It is about aligning all legal structures, will beneficiary forms, account titles, property deeds, trust ownership, powers of attorney, healthcare directives. If they do not work together, the plan can fail. This is the ninth principle. Estate planning is coordination. A will by itself is not coordination. Now, let us talk about trusts. A trust is not just a document. It is a legal relationship. A trust exists when one person, often called the grantor or settler, transfers property to a trustee to manage for the benefit of beneficiaries. This creates a separation between legal ownership and beneficial ownership. The trustee has legal control. The trustee manages the assets, follows the terms of the trust, makes distributions, keeps records, and acts according to fiduciary duties. The beneficiaries receive the benefit. They may receive income, principal support, or future distributions depending on what the trust says. This separation is the reason trusts exist. One person or institution manages. Another benefits the rules are written in the trust. That structure allows continuity, timing, privacy, and control. A trust can say assets should be used for a child's health, education, maintenance, and support. It can say a beneficiary receives distributions at certain ages. It can protect a young beneficiary from receiving too much too soon. It can provide for a surviving spouse while preserving assets for children from a prior marriage. It can create a structure that continues after death. That is the 10th principle. A trust is about structure. It is not simply about who gets what. It is about how, when, and under whose control. There are many kinds of trusts, but most families first encounter two broad ideas: a living trust and a testamentary trust. A living trust is created during your lifetime. It can be revocable or irrevocable. It can operate while you are alive during incapacity and after death, depending on its terms. When someone casually says, "I have a trust," they usually mean a revocable living trust. A testamentary trust is different. It is created inside a will and comes into existence only after death. Because it is created through the will, it does not avoid probate. It is born out of probate. That is a common source of confusion. A testamentary trust can provide post-death control. It can be useful for minor children, financially irresponsible beneficiaries, blended families, or staged distributions. But it is not a probate avoidance tool. This is the 11th principle. A testamentary trust can control assets after death, but it does not avoid probate because it is created by the will. Now, let us focus on the revocable living trust, because this is the trust most families mean when they ask whether they need a trust. A revocable living trust is created during your lifetime, while you are alive and competent. You can usually act as your own. You manage the assets, you can amend the trust, you can revoke it, you can buy and sell property in everyday life. Very little may feel different, but legally, assets that are properly titled in the trust can be administered through the trust instead of probate. The phrase properly titled is essential. A trust only works on assets that are funded into it or directed to it. If you sign a trust document but leave your house and accounts outside the trust may not avoid probate for those assets. An unfunded trust is often just expensive paperwork. That is the 12th principle. A trust must be funded to work. Creating the document is step 1. Retitling assets into the trust is step 2. Many families fail at step 2. They pay for a trust, put the binder on a shelf, and never transfer the house, never update accounts, never coordinate beneficiary designations, and never revisit the structure. Then, when death occurs, assets are still in the individual's name. Those assets may still go through probate. The family says, "But we had a trust." The answer is yes, but the assets were not in it. This is one of the biggest estate planning mistakes. A trust is not a magic box unless you put things into the box. Now, what does a revocable living trust do well? It can avoid probate for assets properly funded into it. It can provide privacy because trust administration is generally handled privately, while probate is a public court process. It can provide continuity during incapacity because a successor trustee can step in if you become unable to manage your affairs. This last point is often underappreciated. Many people think estate planning is only about death. It is not. Estate planning is also about what happens if you are alive but cannot act. Dementia, stroke, serious illness, accident, cognitive decline. If you become incapacitated and no one has legal authority to manage your assets, your family may need to go to court for guardianship or conservatorship. That process can take time. It can require medical documentation, court hearings, lawyers, and public filings. During the waiting period, accounts may be frozen or difficult to access. Bills may go unpaid. Family members may be unable to help efficiently. That is the limbo family's fear. A revocable living trust can reduce that friction if the assets are already titled to the trust and a successor trustee is named. The successor trustee does not need to become owner in a personal sense. They step into a role already created by the trust. They manage the trust assets according to the rules. If you recover, control can return to you. If incapacity, this is why I view incapacity planning as one of the strongest arguments for a revocable living trust. That is the 13th principle. A trust is not only a death document, it can be a life document for incapacity and continuity. A will cannot do this. A will does nothing while you are alive. If you become incapacitated, the will still sits there with no legal effect. This is why a will alone may be incomplete for families worried about incapacity. Now, there is another tool for incapacity, a durable financial power of attorney. Every adult should consider having one. A durable power of attorney allows someone to act on your behalf if you become incapacitated. The agent can handle financial matters depending on the powers granted. It can be very useful and should often be part of a complete plan. But a power of attorney can have limitations. Financial institutions may question it. They may require their own forms. They may reject old documents. They may treat authority differently from one account to another. It operates on an account-by-account basis. A trust works differently for assets owned by the trust. The successor trustee is not asking to act under a personal agency power over an asset in your name. They are stepping into the trustee role under an existing legal structure. This can make administration smoother. That does not mean a trust replaces a power of attorney. It does not. A complete incapacity plan may include a revocable trust, a durable financial power of attorney, a healthcare power of attorney, and a living will or advance directive. Each document has a different job. The trust handles trust assets. The financial power of attorney can handle assets outside the trust and other financial matters. The healthcare power of attorney handles medical decision making. The advance directive or living will can express wishes about medical treatment. Together, they create a system that is the 14th principle. Incapacity planning requires a team of documents, not one document pretending to do everything. This is another reason estate planning must be coordinated. If you have a trust but no healthcare directive, your assets may be easier to manage, but medical decisions may still be unclear. If you have a power of attorney but no trust, some institutions may create friction. If you have a will but no incapacity documents, your family may be forced into court before death. The goal is to make one of life's hardest moments easier for the people you love. Friction matters. Court delays matter. Privacy matters. Authority matters. Now, let us talk about privacy. Probate is a court-supervised process. Court records generally become public. That means the will, the assets, the beneficiaries, and the distributions may become visible through court filings. For some families, this does not matter much. For others, it matters a lot. A family with conflict may want privacy. A person with significant assets may want privacy. A blended family may want privacy. A public person may want privacy. A person who simply does not want the world to know who inherited what may want privacy. Trust administration is generally private. The trust does not need to be filed in the same way a will is filed for probate. The successor trustee administers the trust according to its terms. This is one reason families choose trusts. That is the 15th principle. Probate is public administration. Trust administration can be private administration. Now, a revocable living trust is powerful, but people misunderstand it. The biggest myth is that a revocable trust avoids taxes. It usually does not. If you retain control, the IRS still treats the assets as yours. The trust does not make your estate smaller. It does not remove assets from your taxable estate. It does not create estate tax savings by itself. A revocable living trust changes administration. It does not change ownership for tax purposes in the way people often imagine. This is the 16th principle. Control and taxation are connected. If you still control the assets, the tax system generally treats them as yours. That is why irrevocable trusts are different. An irrevocable trust usually requires giving up control. Because control is given up, certain irrevocable trusts can sometimes provide estate tax reduction, asset protection, Medicaid planning, or advanced wealth transfer benefits. But the trade-off is serious. You no longer control the assets in the same way. This is not everyday middle-class planning for most families. It is used in more advanced situations, long-term care planning, large estates, business succession, asset protection, and specific tax strategies. The key is not to hear the word trust and assume every trust does the same thing. A revocable living trust is mainly about probate avoidance, privacy, continuity, and administration. An irrevocable trust may be about asset protection, tax planning, Medicaid planning, or advanced transfer strategy, but only because control is limited or given up. That is the 17th principle. The type of trust matters more than the word trust. When someone says, a trust avoids taxes, ask what type of trust. When someone says, a trust protects assets, ask what type of trust. When someone says, a trust avoids probate, ask whether it is funded. The details determine the result. Now let us clear up the common myths. Myth 1. Trusts avoid taxes. Revocable trusts do not generally avoid estate taxes because you retain control. Certain irrevocable trusts may help with taxes, but only with trade-offs and proper planning. Myth 2. Having a trust automatically avoids probate. Only if the trust is properly funded. Assets left outside the trust may still go through probate. Myth 3. A will controls everything. No, A will controls probate assets. It does not override beneficiary designations, joint ownership, or trust ownership. Myth 4. Testamentary trusts avoid probate. No, testamentary trusts are created through a will and therefore come from the probate process. They can control distributions after death, but they do not avoid probate. These myths all come from one underlying problem. People confuse documents with structures. That is the 18th principle. Estate planning is not about having impressive documents. It is about having legal structures that match your intentions. Now, let us compare a will and a revocable living trust in simple terms. A will equals death, probate, and public process. It activates at death. It works through court. It becomes part of the public record when filed. It can name guardians for minor children. It can direct probate assets. It is often simpler and less expensive. It may be sufficient for many simple estates. A revocable living trust equals life, incapacity, privacy, and continuity. It exists during life. It can allow a successor trustee to act during incapacity. It can keep properly funded assets out of probate. It can allow private administration after death. It can create distribution rules. It can manage complexity. It costs more and requires ongoing attention. Neither is automatically better. The right choice depends on your assets, family, state law, privacy concerns, incapacity concerns, and tolerance for probate. That is the 19th principle. The right estate plan is the one that solves your actual problems, not someone else's checklist, not a social media template, not the cheapest document, not the most complex document, the structure that fits your life. Now, when might a will be enough? A will may be sufficient if your estate is simple, your assets are modest. Most major assets pass through beneficiary designations. Your family dynamics are straightforward, and probate in your state is not especially costly or burdensome. If you have proper powers of attorney, healthcare directives, and updated beneficiary designations, a will may be an appropriate baseline. Cost matters too. Trusts are typically more expensive to create. They require funding, they require maintenance, they require attention when assets change. If your estate is simple, you may not need that structure. Do not create complexity just to feel sophisticated. That is the 20th principle. Complexity has a cost. Use it only when it solves a real problem. Now, when does a revocable living trust make sense? It may make sense when avoiding probate matters. Some states have slow or expensive probate. Some families want to minimize court involvement. Some want a smoother transfer. It may make sense when privacy matters. It may make sense when you own real estate in multiple states. Without a trust, your estate may need probate in more than one state. This is called ancillary probate. A trust can consolidate administration. It may make sense when incapacity planning matters strongly to you. If you want a loved one to step in quickly and privately without court involvement, a funded trust can help. It may make sense when family complexity exists. Blended families, second marriages, minor beneficiaries, beneficiaries with poor financial judgment, special family circumstances, or distribution concerns can all point toward a trust. It may make sense when you want staged distributions instead of outright inheritance. For example, you may not want a young adult to receive a large inheritance all at once. A trust can say the money is available for health, education, maintenance, and support, and then distributed later at certain ages or milestones. A will can create a testamentary trust for this purpose, but that still goes through probate. A revocable living trust can create post-death trust structures privately if properly funded. That is the 21st principle. Trusts shine when timing, privacy, continuity, or family complexity matter. Now, let us think about minor children. If you have minor children, you need a will because guardianship lives there. But you may also need a trust because minor children cannot responsibly receive assets outright. If a child inherits a large amount directly, a court may need to supervise the money until the child becomes an adult. Then, at 18 or another legal age, depending on state law, the child may receive control. Most parents do not want an 18-year-old receiving a large inheritance outright. A trust can hold and manage assets for the child over time. This is why parents often need both. The will nominates guardians. The trust manages money. That is the 22nd principle. For parents, guardianship and asset management are separate problems. A will solves one. A trust can solve the other. Now let us think about blended families. In a first marriage with shared children and simple assets, planning may be easier. In a second marriage, the issues multiply. You may want to provide for a surviving spouse, but also preserve assets for children from a prior relationship. Joint ownership may accidentally give everything to the surviving spouse. Beneficiary designations may bypass children. A will may not override title. A trust can create a more precise structure. It can allow a surviving spouse to benefit during life while preserving remaining assets for children later. It can define who controls assets, when distributions are made, and what happens after the spouse dies. This is where trust planning can prevent conflict. That is the 23rd principle. Complex family relationships require explicit legal structure. Good intentions are not enough. Now let us discuss property in multiple states. Real estate is governed by the state where the property is located. If you die owning real estate in your name in more than one state, your family may face probate in your home state and ancillary probate in the other state. That can mean more court filings, more lawyers, more cost, and more delay. A revocable living trust properly funded with those properties can simplify administration. This is a practical reason for a trust, not because trusts are fancy, because they can reduce multi-state friction. That is the 24th principle. The more jurisdictions involved, the more valuable coordination becomes. Now, let us talk about funding again because it is the point people keep missing. A trust that owns nothing controls nothing. If your house is still titled in your individual name, it may be a probate asset. If your bank account is still in your name with no beneficiary or trust ownership, it may be a probate asset. If your brokerage account is outside the trust and has no transfer. On death designation, it may be a probate asset. If your trust exists, but your assets do not connect to it, your estate plan may not function as expected. Funding is not glamorous, but it is essential. Deeds may need to be changed. Accounts may need to be retitled. Beneficiary designations may need to be coordinated. Some assets may not belong in the trust. Retirement accounts, for example, require careful beneficiary planning because tax consequences matter. You do not casually retitle every asset without advice. That is the 25th principle. Funding a trust requires asset decisions. Do not assume one instruction covers everything. A qualified estate planning attorney should guide the process. Financial institutions may have forms. Deeds must be recorded properly. Beneficiary designations should be reviewed. Account titles should be checked periodically. This is implementation. Without implementation, planning fails. Now let us think about probate. Probate is not always terrible. Some people treat probate like a disaster in every case. That is too simple. Probate differs by state. In some places, it is slow, costly, and public. In others, it may be manageable for simple estates. Some assets may avoid probate through beneficiary designations regardless of whether there is a trust. The question is not whether probate is always bad. The question is whether probate creates enough cost, delay, public exposure, or complexity in your situation to justify a trust. That is the 26th principle. Probate risk is local and personal. Do not accept blanket answers. Now, let us talk about creditor protection. A will does not generally provide creditor protection. A revocable living trust does not generally provide creditor protection because you still control the assets. If you can revoke the trust and take the assets back, your creditors may often be able to reach them too. The exact rules vary, but the core idea is that retained control limits protection. Certain irrevocable trusts may provide asset protection if properly structured and if transfers are not fraudulent or made too late. But that is advanced planning. Again, type matters. That is the 27th principle. Control is convenient, but control limits protection. This is the trade-off. People want full control, tax savings, probate avoidance, creditor protection, Medicaid protection, privacy, and simplicity. All in one document. The legal world rarely gives all of that at once. If you keep control, you often keep tax exposure and creditor exposure. If you give up control, you may gain protection, but lose flexibility. Estate planning is trade-offs. A good plan is not the plan that promises everything. It is the plan that chooses the right trade-offs for your life. Now, let us discuss estate taxes. Many middle-class families do not owe federal estate tax because the federal exemption is high, but state estate taxes, inheritance taxes, and future law changes can matter depending on location and wealth level. A revocable trust alone is not an estate tax strategy. More advanced planning may be needed for large estates, but do not buy advanced tax planning if your estate does not need it. At the same time, do not assume taxes are irrelevant if you have significant assets or live in a state with its own rules. The 28th principle, tax planning should match the size and location of the estate. Not every estate needs tax planning. Every estate needs structure planning. Now, let us talk about beneficiary designations in more detail. They are simple but powerful. A retirement account beneficiary form can transfer a large account outside probate. A life insurance beneficiary form can transfer money directly. A payable on-death bank account can transfer cash. A transfer on a death brokerage account can transfer securities. This can be useful, but beneficiary designations must be coordinated with the rest of the plan. If you leave one child on a beneficiary form and assume that child will share with siblings, you may create conflict. Legally, the named child may own the money. If you name a minor child directly, you may create court supervision issues. If you name your estate as beneficiary of certain retirement accounts, you may create unnecessary tax or probate complications. If you forget to update an ex-spouse, the result may surprise everyone. The form matters. This is the 29th principle. Beneficiary forms are estate planning documents. Treat them with the same seriousness as a will. Many people sign beneficiary forms casually when opening accounts. Then they never review them. But those forms may control more wealth than the will. Review them after marriage, divorce, birth, death, estrangement, major asset changes, and estate plan updates. The legal system will follow the form. Now, let us think about joint ownership. Joint ownership can be simple and useful. A married couple may own a home jointly. A joint bank account may allow easy access. But joint ownership also has risks. It can override a will. It can expose assets to the other joint owner's creditors. It can create unintended gifts. It can create family conflict. It can make one person the automatic owner even if that was not the long-term intention. This is especially important when elderly parents add adult children to accounts for convenience. They may think they are only giving the child authority to help pay bills. Legally, they may be creating ownership rights. That can affect probate, taxes, creditors, Medicaid, and family disputes. A power of attorney may be more appropriate for convenience in some cases. Again, get advice. The 30th principle. Convenience ownership can create unintended inheritance. Now, let us talk about incapacity through a real-world lens. If a person suddenly becomes incapacitated without a trust and without effective powers of attorney, the family may be unable to act. They may know what should be done. They may have the best intentions, but knowing and caring are not enough. Legal authority is required. The family may have to petition the court. This takes time. During that time, bills may continue. Medical decisions may need to be made. Property may need management. Accounts may be inaccessible. Businesses may suffer. Investments may need attention. That limbo is not just inconvenient, it is painful. A good estate plan reduces limbo. That is the 31st principle. The purpose of incapacity planning is to let love act legally. Your family may love you, but love without authority can be trapped outside the door. Documents create authority, trust create continuity. Powers of attorney create agency, healthcare directives create medical clarity. Do not leave your family with love but no legal tools. Now, let us discuss a healthcare power of attorney and advance directive. These documents are not the same as a financial power of attorney or trust. They deal with medical decisions, who can speak for you if you cannot. What treatment preferences have you expressed? What end of life choices do you want considered? Estate planning is incomplete if it only discusses money. Incapacity often begins as a medical event, stroke, accident, dementia, illness. The medical side and financial side must work together. That is the 32nd principle. A complete plan protects both assets and decisions. Now, let us think about what happens after death in a trust plan. If a revocable trust is properly funded, the successor trustee administers the trust privately. The trustee follows the instructions. Assets may be distributed outright, held in continuing trusts, or used for specified purposes. There may still be bills, taxes, notices, accounting, and administration. A trust does not eliminate work. It changes the process. Some families think a trust means nothing, needs to be done after death. That is wrong. Trust administration still requires responsibility. The successor trustee must act properly. They may need legal and tax help. They may need to value assets, pay debts, file returns, communicate with beneficiaries, and distribute assets according to the trust. The difference is that this can often happen without the same court supervision as probate. That is the 33rd principle. A trust avoids certain court processes, not all responsibility. Now let us discuss choosing people. An estate plan is only as good as the people appointed to carry it out. Executor, trustee, successor, trustee, guardian, financial agent, healthcare agent. These roles require trust, competence, availability, and judgment. The person who is emotionally closest may not always be the best administrator. The oldest child may not be the best trustee. A spouse may not be able to handle complex finances during grief. A child with financial problems may not be a good choice. A family member in conflict with others may create more disputes. Choose roles carefully. That is the 34th principle. People are part of the structure. A bad appointment can weaken a good document. You may also choose professional fiduciaries in some cases. That can add cost but reduce family conflict. The decision depends on complexity, family dynamics, asset size, and trust. Now, let us talk about distribution timing. One major benefit of trusts is that you do not have to distribute everything all at once. You can create rules. A child may receive part at 25, part at 30, part at 35. A beneficiary may receive money for health, education, maintenance, and support. A trustee may have discretion. A surviving spouse may receive income while principal is preserved for children. A beneficiary with poor judgment may be protected from receiving too much too quickly. This is not about controlling people from the grave in an unhealthy way. It is about recognizing that not every beneficiary is ready for outright ownership at the same time. A 22-year-old receiving a large amount of money may not have the maturity to manage it. A beneficiary with addiction, creditor issues, divorce risk, disability, or special circumstances may need protection. This is where trusts are valuable. That is the 35th principle. Inheritance timing can matter as much as inheritance amount. Money given too early or in the wrong form can harm rather than help. A trust allows structure. Now, special needs planning is another area where trusts may matter, though the source does not go deeply into it. If a beneficiary receives government benefits, an outright inheritance can disrupt eligibility. Special needs trusts and related planning may be needed. This is advanced and requires specialized legal help. The broader principle is this: beneficiary circumstances matter. Do not assume equal shares distributed outright is always the best plan. That is the 36th principle. A good estate plan fits the beneficiaries, not just the assets. Now, let us return to the central mental model. A will equals death plus probate plus public. A revocable living trust equals life plus incapacity plus privacy. This is not perfect in every detail, but it is useful. A will activates at death and speaks to the probate court. A revocable trust exists during life, can provide continuity during incapacity, and can privately administer properly funded assets after death. Funding may matter more than the documents themselves. Control equals taxation. Guardianship lives in the will. Those are the core ideas. If you remember nothing else, remember that. This is the 37th. The right mental model prevents the wrong expectations. Now let us think about the order in which someone should approach planning. First, list all assets: homes, bank accounts, brokerage accounts, retirement accounts, life insurance, business interests, vehicles, personal property, digital assets. Second, identify how each asset is titled. Trust ownership, entity ownership. Third, identify beneficiary designations. Who is named? Are there contingent beneficiaries? Are they updated? Fourth, identify which assets would go through probate if you died today. Fifth, identify incapacity authority. Do you have a durable power of attorney? Healthcare power of attorney. Advance directive. Trust with successor trustee. Sixth, identify family complexity. Minor children, blended family. Second marriage. Beneficiaries with special needs. Conflict. Financial irresponsibility. Seventh, decide what problems need solving. Probate avoidance. Privacy, incapacity, guardianship, distribution timing, multi-state property, tax planning, asset protection, Medicaid planning. Only after that should you choose documents. That is the 38th principle. Do not start with the document. Start with the problems the document must solve. This is where many people go wrong. They ask, do I need a trust? The better question is, what would a trust solve in my specific life? If the answer is nothing meaningful, maybe a will and proper beneficiary designations are enough. If the answer is probate, privacy, incapacity, property in multiple states, or complex beneficiaries, then a trust may be worth the cost. Now, let us discuss cost. A will is usually simpler and cheaper. A revocable living trust costs more, requires more administration, and needs funding. The higher cost may be justified if the trust solves real problems. It may not be justified if it does not. Do not make estate planning decisions based only on cost, but do not ignore cost. A cheap document that fails your family is expensive. An expensive structure that solves no real problem is wasteful. That is the 39th principle. Value is measured by the problem solved, not by the price alone. Now, let us talk about maintenance. Estate plans age. Beneficiaries change. Children become adults. Executors die or become unsuitable. Relationships change. Assets are sold. New accounts are opened. Homes are bought in new states. Tax laws change. Estate laws change. Family conflict changes. If you create a plan and never review it, the plan can become misaligned. Review your estate plan periodically and after major life events: marriage, divorce, birth, death, move to another state, purchase of real estate, sale of business, major inheritance, change in health, change in family relationships. That is the 40th principle. An estate plan is not finished forever. It must stay aligned with life. Now, let us think about digital assets. The source does not emphasize them, but modern estates increasingly include digital accounts, crypto, online businesses, passwords, cloud data, social media, and subscription accounts. These require careful planning. A will or trust may not automatically give someone access. Terms of service, passwords, private keys, and laws may matter. The broader point remains structure. If your family cannot access or identify an asset, the legal plan may not be enough. This is another reminder that estate planning is not just documents. It is administration. That is the 41st principle. Assets that cannot be found or accessed may be lost even if legally inherited. Keep organized records. Now, let us return to the emotional purpose of estate planning. Estate planning is not only about money. It is about reducing confusion when people are grieving. It is about preventing conflict when emotions are high. It is about giving authority when someone is incapacitated. It is about protecting children. It is about preserving privacy. It is about making sure the structure reflects the love and responsibility you intended. When planning is missing or unclear, families can fight. Not always because they are bad people, because grief, money, uncertainty, and unclear authority are a dangerous combination. Good planning reduces ambiguity. That is the 42nd principle. Clarity is a gift to the people you love. Now, let us think about what happens if there is no will. If a person dies without a will, they die intestate. State law determines who receives probate assets. The result may not match what the person wanted. An unmarried partner may receive nothing. Children from different relationships may receive shares in ways that create conflict. A court may decide guardianship issues without your written preference. Probate still occurs. Dying without a will means the state's default plan becomes your plan. That is the 43rd principle. If you do not write a plan, the law writes one for you. It may not be the plan you wanted. This is why every adult should at least consider a will, powers of attorney, and healthcare directives, even if they do not need a trust. Now let us address young adults. Many young people think estate planning is for older people or wealthy people. That is too narrow. A young adult may not need a trust, but they may need healthcare directives and powers of attorney. Once a child becomes an adult, parents may no longer have automatic authority to access medical or financial information. If a young adult is injured or incapacitated, documents matter. Estate planning begins with authority. Who can act? That applies at every adult age, the 44th principle. Estate planning is not only wealth planning, it is authority planning. Now, let us think about business owners. A business owner may need more planning. Who can operate the business if the owner becomes incapacitated? Who inherits the ownership? Is there a buy-sell agreement? Does the operating agreement coordinate with the estate plan? Does the business have key person insurance? Does the trust own the interest, or does the entity agreement restrict transfer? A will alone may be too crude for business succession. Business interest can create liquidity, tax, management, and family conflict issues. The principle remains. Structure must match complexity. Now, let us discuss retirement accounts and trusts. Retirement accounts have special tax rules. Naming a trust as beneficiary can be useful in some situations, especially for control or protection. But it must be drafted carefully. The Secure Act and related rules changed inherited retirement account planning. If done improperly, a trust beneficiary designation can accelerate taxes or create complications. The simple lesson is do not retitle retirement accounts into a revocable trust during life without advice, and do not name a trust as beneficiary without understanding the tax rules. Again, asset by asset planning matters. That is the 45th principle. Retirement accounts require beneficiary planning, not assumptions. Now let us return to the issue of creditor protection. If you leave assets outright to a beneficiary, those assets may become exposed to that beneficiary's creditors, divorce, lawsuits, or poor spending. Continuing trusts can sometimes provide a layer of protection depending on state law and trust terms. This is another reason trusts can be useful for certain families. The goal may not be only probate avoidance. It may be protecting beneficiaries from their own risks. That is the 46th principle. Sometimes the risk is not the transfer. It is what happens after the transfer. A beneficiary may be responsible today and irresponsible later. A child may marry someone problematic. A lawsuit may happen. A business failure may occur. A trust can sometimes provide structure that outright inheritance cannot. This is not always necessary, but for some families it matters. Now, let us talk about communication. An estate plan does not always need to reveal every dollar to beneficiaries. Privacy can be valuable, but the people in key roles should know where documents are and what their responsibilities are. A trustee who does not know they are trustee may be unprepared. A guardian nominee may not know your wishes. An executor may not know where the original will is. A healthcare agent may not know your values. Documents work better when the right people know enough to act. That is the 47th principle. A hidden plan may fail at the moment it is needed. Tell your key people where to find documents. Make sure institutions will accept them. Keep originals or copies according to your attorney's guidance. Review names and contact information. Now, let us think about the original question again. Does your will control everything you own? No, it controls probate assets. Some assets pass by contract, some pass by title, some pass by trust, some pass through probate. A will matters, but it is only one part of the system. The tragedy is that many families discover this only after death, when the person who could have changed the paperwork is no longer here. At that point, intention cannot be clarified. The system follows the structure that exists. This is the 48th principle. Estate planning must be fixed while the person with authority is still alive and competent. After death, the structure is usually locked. This is why urgency matters, but not panic. You do not need to run to the first online document mill. You need to understand your assets, your family, your state, your risks, and then sit down with a qualified estate planning attorney. The goal is not to buy a document. The goal is to build a structure. Now, let us consider why this matters so much in blended families. A person may say, my spouse will do the right thing. Maybe they will. But estate planning should not depend entirely on hope. A surviving spouse may remarry. They may change their own will. They may experience creditor problems. They may favor their own children. They may become incapacitated. They may die with a different plan. If you want children from a prior marriage to be protected, you need structure. A trust can create that structure. Joint title may destroy it. Beneficiary designations may bypass it. A will alone may not solve it. This is the 49th principle. Blended family planning must be explicit because default structures can produce unintended disinheritance. Now, let us think about the role of fairness. Families often say, just split everything equally. But equal division is not always simple. One child may have received lifetime gifts. One child may be disabled. One child may work in a family business. One child may be financially irresponsible. One child may live in the family home. One asset may be illiquid. Taxes may differ. Beneficiary designations may already divide assets differently. A good estate plan defines fairness legally. Without structure, fairness becomes an argument. That is the 50th principle. Fairness must be translated into legal mechanics. A feeling of fairness is not enough. Now, let us talk about court involvement. Courts are necessary when disputes arise or when law requires supervision. Probate is not evil, it is a process. But court processes can be slow, public, and expensive. They can add stress during grief. If your goal is to reduce court involvement, a funded revocable trust may help. If you are comfortable with probate, have a simple estate, and state procedures are efficient, a will may be enough. Again, it depends. Estate planning is personal. That is why the best advisor is not the one who sells everyone the same structure. It is the one who helps you understand which structure solves your actual problems. Now, let us think about incapacity once more because it is so important. Death is certain. But incapacity can be more complicated than death because the person is alive, needs care, has bills, may still own assets, and may still have dependents or business obligations. If authority is unclear, the family is stuck. A will does nothing. A power of attorney may help. A trust may help for trust assets. Healthcare documents help for medical decisions. Together, they reduce friction. This is one of the most practical reasons to plan. The 51st principle, planning for incapacity, can be more immediately valuable than planning for death. Most people underestimate that. Now, let us bring this into a clear action framework. First, make a list of every asset you own. Second, mark how each asset transfers, beneficiary, joint title, trust, or probate. Third, review all beneficiary forms. Fourth, review all titles and deeds. Fifth, decide whether probate avoidance matters in your state. Sixth, decide whether privacy matters. Seventh, decide whether incapacity continuity matters. Eighth, make sure you have a will naming guardians. Ninth, make sure you have durable financial and healthcare powers of attorney. 10th, consider whether a revocable living trust solves real problems. 11th, if you create a trust, fund it properly. 12th, review the plan after major life changes. This is not complicated conceptually, but it requires attention. And attention is what most estate plans are missing. Now, let us talk about what not to do. Do not assume your will controls beneficiary accounts. Do not assume your trust works if unfunded. Do not assume joint title matches your will. Do not assume a revocable trust saves estate taxes. Do not assume a testamentary trust avoids probate. Do not assume a power of attorney will always be accepted smoothly. Do not assume guardianship can be named in a trust. Do not assume a cheap will solve complex family problems. Do not assume an expensive trust solves problems you never identified. Do not assume your family will figure it out later. They may not. And even if they can, they should not have to. That is the 52nd principle. The purpose of estate planning is to remove avoidable burdens from the people who will already be carrying grief. Now let us consider the emotional cost of poor planning. A child may think a parent intended to leave assets equally. Then a beneficiary form sends everything to one sibling. The other siblings feel betrayed. The named sibling feels legally entitled. The will says one thing, the account says another. The family fractures. A spouse in a second marriage may receive everything by survivorship. Children from the first marriage may be left out. The deceased parent may never have understood title would do that. The children may never forgive the result. A parent may die with a will but no trust. And probate becomes public, slow, and stressful. Assets are delayed. Bills continue. Family members argue. The executor struggles. A person may become incapacitated without trust or power of attorney, and the family is stuck in court while accounts remain inaccessible. These outcomes are not rare because people are evil. They are common because structures are misaligned. The 53rd principle. Most estate planning disasters are structure problems before they become family problems. Fix the structure early. Now let us talk about professional advice. A qualified estate planning attorney is important because state law matters. Probate rules differ, trust rules differ, property titling differs, community property rules differ, elective share rules differ, estate tax rules differ, guardianship rules differ, power of attorney acceptance can vary, do-it-yourself forms may misstate. Specific requirements or family-specific issues. Education is valuable because it helps you ask better questions. It does not replace legal advice. That is the 54th principle. Use education to become a better client, not your own unqualified lawyer. When you meet an attorney, you should know enough to ask about contracts, titles, probate assets, funding, incapacity, guardianship, beneficiary designations, and whether a trust solves real problems. That knowledge improves the conversation. Now, let us reflect on the deeper purpose. Estate planning is not about death in a morbid sense. It is about control and continuity. Who controls assets if you cannot? Who controls them after you die? When does control change? How do assets move? Who benefits? When do they benefit? What process must the family go through? How much is public? How much court involvement exists? What happens to minor children? What happens to beneficiaries who need structure? These questions are not abstract. They become very real when a family is in crisis. This is why the work must be done in advance. That is the 55th principle. The best estate plan is built before emotion takes over. Now, I want to return to the phrase legal structure is mechanical. This is the heart of everything. The court cannot ask the deceased person what they meant. The insurance company will not ignore the beneficiary form because the will says something else. The deed will not change itself because the family thought ownership meant something different. The retirement account custodian will not distribute based on a conversation at Thanksgiving. The system follows the documents. Therefore, the documents must be right. And not only the documents, the titles, the beneficiary forms, the trust funding, the powers of attorney, the healthcare directives, the guardian nominations, the whole structure. This is the 56th principle. Your estate plan is only as strong as the weakest structure controlling a major asset. If your will is excellent but your beneficiary forms are wrong, the plan can fail. If your trust is excellent but unfunded, the plan can fail. If your guardian nomination is missing, the plan can fail for your children. If incapacity documents are missing, the plan can fail during life. If joint title is wrong, the plan can disinherit someone unintentionally. Planning must be comprehensive. Now, let us discuss simplicity one more time. Not everyone needs This is important because many people are sold trusts they do not need. If your estate is small, assets have beneficiaries, family is simple, probate is not burdensome, and incapacity is covered with powers of attorney, a will may be enough. Do not let fear sell you complexity, but do not let simplicity become negligence. If you own real estate in multiple states, have a blended family, want privacy, worry about incapacity, or want structured distributions, a trust may be appropriate. The right answer is not universal. The right answer is diagnostic. That is the 57th principle. Estate planning should be diagnosed, not prescribed generically. A doctor should not give every patient the same treatment. An estate planner should not give every family the same structure. Now, let us think about updating beneficiaries as a simple high-impact step. This can often be done without a full legal overhaul. Log into retirement accounts. Review beneficiaries. Check primary and review bank accounts with payable. On death features, review brokerage transfer. On death designations, confirm names, percentages, and backup beneficiaries. This simple step can prevent huge problems, but do it in coordination with the overall plan. For example, if a trust is part of the plan, some accounts may need the trust as beneficiary, while others may not. Tax rules matter. Minor beneficiaries matter. Special needs beneficiaries matter. Still, beneficiary review is one of the easiest ways to find hidden contradictions. That is the 58th principle. The simplest estate planning mistakes often hide in beneficiary forms. Now, let us talk about pour-over wills. A revocable living trust plan often includes a pour-over will. This will says that any probate assets not already in the trust should pour over into the trust at death. It is a backup tool, but it still requires probate for those assets because the assets were not funded into the trust during life. A pour-over will is not a substitute for funding. It is a safety net. The goal is not to rely on the safety net. The goal is to fund the trust properly in the first place. That is the 59th principle. A backup plan is not the same as implementation. Now let us think about trust control during life. A common fear is that creating a revocable living trust means losing control. In a revocable trust, while you are alive and competent, you usually retain control. You can be your own trustee. You can change the trust. You can revoke it. You can manage assets. This is why revocable trusts are flexible. But because you retain control, you do not get asset protection or estate tax removal from that structure. Again, control is the trade-off. If you want convenience, continuity, and privacy while retaining control, a revocable trust may fit. If you want asset protection or tax removal, you may need irrevocable planning, and that requires giving up control. The 60th principle, you must choose between control and certain protections. You rarely get both fully. Now, let us consider why families delay. They think they are too young. They think they do not have enough money. They think the will from 20 years ago is fine. They think their spouse will handle everything. They think their children will cooperate. They think beneficiary forms are updated. They think probate is not a big deal. They think incapacity will not happen. They think trusts are only for the rich. They think death planning can wait. Delay is common because estate planning is emotionally uncomfortable and not urgent until it is too late. But once urgency arrives, options may shrink. Incapacity can remove the ability to sign documents. Death locks in structures. Family conflict hardens positions. Court processes begin. That is the 61st principle. Estate planning is easiest when it feels least urgent. Do it then. Now let us bring all of this to a final synthesis. A will is important but limited. It controls probate assets. It names executors. It nominates guardians for minor children. It works through probate. It becomes public when filed. It has no effect during life or incapacity. A revocable living trust is a structure created during life. It can avoid probate for funded assets. It can provide continuity during incapacity. It can keep administration private. It can create distribution rules. It does not generally reduce estate taxes. It does not generally protect from creditors. It must be funded. An irrevocable trust is different. It may provide advanced protection, tax planning, Medicaid planning, or wealth transfer benefits, but only because control is given up. Beneficiary designations and title often override wills. Probate applies to assets not transferred by other mechanisms. Guardianship for minor children belongs in a will. Incapacity planning requires more than a will. This is the complete architecture. Now, what should you do? List the assets. Identify the transfer mechanism, review beneficiary forms, check titles, decide whether probate matters, decide whether incapacity continuity matters, decide whether privacy matters, decide whether family complexity requires structure. Make sure minor children have guardian nominations in a will. Use powers of attorney and healthcare directives. If you create a trust, fund it. Review the plan regularly. That is estate planning in a practical sense, not magic, not mystery structure. And once you understand structure, the question changes. You no longer ask, do I need a will or a trust? You ask, what controls each asset? What controls each asset if I become incapacitated? Who has authority? When does authority change? What process does my family have to go through? Who receives the benefit? When do they receive it? Is the result private or public? Is the structure aligned with my intention? Those are the right questions, and the right questions prevent the wrong outcomes. Estate planning is not about predicting death. It is about removing chaos from the people you love. If your will says one thing, your beneficiary form says another, and your title says a third thing, the system will not pause and ask what you really meant. It will execute the structure. So build the structure before the structure builds the outcome for you. That is the lesson. A will may be enough for some. A trust may be essential for others. Most people need at least a will, beneficiary review, durable power of attorney, healthcare directive, and clear understanding of how assets transfer. Some families need more. The key is not to guess, know what controls what, because when the hardest moment comes, the law will not follow memory, hope, or intention. It will follow the paperwork. Make sure the paperwork tells the truth.